Welcome to the Rose Show podcast.
Welcome to Post-Fed Meeting Analysis, discussion with Michael Kramer of Mott Capital on the Fed, rates, macro markets, and more. Thank you everyone for joining us this afternoon. We hope to make this space educational and lots of fun. Quick disclaimer, please do not construe this as investment or financial advice. I'm Rosanna, your host, and I'm here with Michael Kramer of Mott Capital. In this space, we will discuss the Fed's decision, some macro, market reaction, and what it means for the market going forward. So let's begin. Michael, I believe 75 basis points was what we all expected.
Correct.
What are your thoughts?
I mean, it pretty much went as I expected it to go. I don't think it went how the market expected it to go, but, what really was funny, because I was watching the market sort of trade as he was talking, and there was a moment right around 3:08 where you were watching it and you're like, oh man, it feels like it's going to run right now if something doesn't happen. And all of a sudden at that moment, he got the question, the markets, our bond market and stock market seem to be responding positively to today's announcement. How do you feel about that? And he started with, we don't target any one specific thing. And then, but I just want to reemphasize, we still have a long way to go. And, we're not pausing anytime soon. And rates are going to have to go much higher than we thought in September. So just want to make that clear. It was like
exactly
everything fell off a cliff because there was nothing you could take away from that to spin it.
Exactly.
And that was sort of the moment, I think, where any hopes that, maybe they were going to change their policy path or do something different, I think just totally went down the drain. And then it was like even hammered home more when he was like, and, he was asked about the chance of a soft landing, is like, yeah, that's narrowed.
Exactly. And I think as the questions came in, the tone got even worse because then he ended up going into his thinking more. And then he said, we have ways to go for sufficient restrictive policy.
Right.
And then the specific words that I think really hopefully resonate with everyone was when Powell said, very premature to even speak of pausing. So to me, hopefully that puts an end to the whole pivot talk that we've been hearing, which I find very inappropriate because, we first have to consider, he keeps consistently saying that it's a slowdown. We have ways to go. Rate hikes are still coming in.
Right.
However, it's a slowdown of those, and we can't even speak of a pause. So a pivot is far off from that.
Yeah, and even if you take that one step further, because he didn't really like completely shut the door either on a potential 75 basis point rate hike in December, right?
Yes,
and,
exactly.
Next you get a hot job report on Friday, and you get a hot CPI reading, which, by the way, the last time I checked, Cleveland Fed is actually higher than estimates for CPI next week.
I have it open on my screen. Yeah, I have it open on my screen right now. I'm looking at it.
Yeah, I think, what is Cleveland Fed right now at?
Cleveland Fed year over year is 8.09 and core is 6.58 for October.
And right now the estimates for next week, year over year, 8.1, and core is 6.6.
Wow, and we know that 18 out of the past 20 times CPI when Cleveland Fed comes in higher than than Cleveland Fed, exactly.
Yeah.
So that's very telling.
And then they also have an 8% reading for November.
Yes, 8.05.
And that's up from yesterday.
Yeah, and it's up from yesterday. The core's up from yesterday too for November to 6.58, the same as October.
Right. And so, that in itself really, really tells you where the Fed needs to go, right? And yeah, I don't, it was like they did this in July and August. He totally, slammed the door on them. And he did the same thing again today. I don't know how many more I guess we'll know we're coming to the end of the rate hiking cycle when no one actually believes they're going to pivot or
Yeah,
pause.
exactly. That's how it always is, right?
Right? When they start saying they're going to start slowing down, and no one actually believes that they're actually going to slow down, is
Then
probably the
they
point
will.
when you know that the cycle is coming to an end.
Great thinking. I agree. I mean, of course, the highly elevated CPI, tight labor market, then Powell goes on to say, we're at a higher level than expected at
Right.
September meeting. So to me, it's even more hawkish, even worse. We're still in the Jackson Hole September tone, but even more so because the inflation is still very high. And as he said, there's no evidence of it coming down. So if this continues, like we said, I mean, yeah, it seems that when they say I think he mentioned December or the following, we can slow down rate
Right.
hikes. But if we
Right.
get this print of over 8%, I don't think it will be December. It seems probably next year.
Probably. And if he's telling you that the SEP from September is too low, then it could be implied that it's too low for this year and too low for next year. So we just don't know
Exactly.
what that implies. But I mean, the data has not been really supportive of a pivot. I think the JOLTS number on Monday was clear of that. I mean, it came in like 1 million more than what was estimated.
Yeah,
And
I know.
um and so I continue to think that as long as as long as inflation is elevated, you can't even. I don't, and it's a little hard. It's a little frustrating at times because you don't know how this stuff sort of even materializes, because if you're kind of working on the fundamentals, and you're working on the and looking at the data, you're like, how is the market even coming to this assessment, right? And I think the tell was earlier this week when we started to see yields start creeping back up. We started seeing the dollar index move up. We saw yesterday, you saw the Fed fund futures creep up over 5%.
Yes,
Now
I
they're
saw
trading
that.
somewhere around 5.1%. And I think it's become it was starting to that message was starting to creep into the markets yesterday, and it largely went, I think, unnoticed by equity prices based off of where the VIX was and based off of where the S&P was. But the bond market, I think, began to reassess that yesterday when and Monday after that JOLTS data. And it's interesting because now, if we look at where Fed fund futures are, they're pricing in rates over 5% by next year, by May or June.
Yes, I see that.
Yeah. So the question is the bond market going to start looking at, because I think he was asked about core PCE, and that's really the lowest metric out there on inflation. And
Yes,
that would suggest that,
5.1.
yeah, I mean, that suggests you need to be at least at 5.1, maybe 5.2, but you need to also probably be above that by a certain amount as well. So, is the futures market going to start thinking about, a 5.25 or 5.5% Fed funds rate? And it goes back to what we were talking about, I think even in September, or maybe it was August, I don't remember, but we were saying that rates were going to need to go much higher.
Yes, and it appears they will. Yeah, I mean, he said that there was a question about that. Does the policy rate need to be above the inflation? And he said that he wants to see real interest rates positive. And then he mentioned the core PCE about 5.1%. So I agree. It seems that by May, I'm looking at FedWatch tool, which is pretty good with their
Yeah.
probabilities. And it looks like by May, we're in the fives, over fives. Very likely, it says 40% of 500 to 525 basis points. And then June, yeah, I mean, over five. So even March looking at March is a possibility of 44% over five.
Right.
So, it's all possible. So we just need to keep that in mind regarding the market. Now, regarding QT, and Powell said he came out straight out on his speech and he said, restoring inflation, we have the tools. He sounded very confident. And I think it's because he's continuing the rate hikes and he's confident inflation, long range inflation is well anchored. And then he mentioned significant reduction in the balance sheet. We're looking at, I think November is like a big month for Treasury issuances. And yeah, right. So, and I know the balance sheet, I'm looking at New York Fed, and I love looking at that for everybody. If you want to see how much the balance sheet is at, it's updated every Thursday, and it's 23.3 billion last week. So we're about 95 billion for the month. I mean, that's a lot of tightening. What are your thoughts on that and its effects on the market?
Yeah, and I think the other thing was I noticed the other day that rates started to move higher after I think the Treasury said they were going to issue. I don't remember the exact number. I thought they said they were going to issue $500 billion between now and year end. Was that right? Do you
I don't
remember?
know. I remember reading about you know what? No, I don't remember that. I don't recall reading that, but I did see something about the net new treasuries coming to the market, which was significant. It was like
Yeah.
240 billion, but I didn't read that tidbit. That's
So yeah,
interesting
there
to know. We
was
should look at
on
that.
October 31st, there was an article here from actually it's not an article, it's from the Treasury. The U.S.
Okay.
Department of Treasury today announces current estimates of privately held net marketable borrowing for October to December and January to March.
Oh yeah. Yes. Okay.
During the October-December 22 quarter, Treasury
Mm-hmm.
expects to borrow $500 billion in privately held net marketable, assuming
Yes.
at an end of December cash balance of $700 billion. The borrowing estimate is
Yes. Wow.
$150 billion higher than what was announced in August. So, I mean, think about that. You're going to get $550 billion in issuance,
Yes.
and you have, arguably maybe another $200 billion rolling off the balance sheet. Well, not $200 billion because MBS is 30, right? I think Treasury is 65.
Yes.
So you have like 130 billion or so coming off from QT. I mean, you have like 680 billion worth of Treasury in 2 months. So,
That's
I
a
mean, that in
lot.
itself could be enough to continue to push yields higher. And
Mm-hmm.
that's going to be a big driver also of potentially further dollar strengthening. And so those two aspects in itself are going to continue to weigh on equity prices as well, because we know that there's a very high inverse correlation between dollar strength and equity market weakness.
Yes. Yes, and that's what I wanted to talk about next. Actually, I wanted to go into the yields. Now, the 2-year is over 4.5%, the 10-year over 4%, and now the 3-month is about 4%. I think we talked about this. So you think that the 10-year could easily go over 4.5%. What are your thoughts on that? Have you changed with your thinking about where those might go? And can you just briefly discuss the effects of those yields on the market?
So yeah, I've been looking for the 10-year to get into that 4.25 to 4.5% range. It's already sort of gotten there back, before the Wall Street Journal article dropped in the middle of October. But I think that, let's just look at it this way, right? If the Fed fund futures are pricing in a 5.1% rate at some point in the next year, you have to think that the 2-year Treasury rises to somewhere around 5%. And
Mm-hmm.
even if the curve stays inverted at 50 basis points, you're talking about a 4.5% 10-year.
Yeah.
So, and depending on how this whole thing with inflation sort of evolves and how the market starts thinking about rates really long term, you know, eventually at some point you would expect the curve to sort of invert if it becomes sort of generally accepted that we're not going back to a sub 2% inflation rate anymore.
Mm-hmm.
Because remember, I think in September we talked about how the CPI index, and I think I've posted this recently, has sort of like bobs and weaves historically in these cycles of 15 years or so, where in the 1940s and 50s, you had a really big period of inflation. In the 60s, you had a period of sort of disinflation, falling inflation rates. In 70s, 80s, and 90s, you had high inflation rates. In the 2000s and aughts, you came down and you had low inflation. And now we're sort of turning up again and seeing inflation rates pick up. So if we're in a 10-year cycle where inflation actually runs hotter than what the
Yes.
previously 10 or 15 years were, then 10-year rates should be higher than where they were. They should be higher, right? Naturally higher. And I think the sort of mistake I think a lot of people make is that they look at the price of copper, and I've made this mistake early on in this cycle, right? Not believing that inflation was going to be long lasting either. I remember October of 2021, I saw the price of oil collapse and I expected inflation to collapse. And of course it didn't. And what I realized at that point was that these commodities are really no longer good gauges for overall CPI, because the inflation that's taking place is in between where it's being taken out of the ground and where the end user's getting it. It's all that stuff that happens in between. And so if the inflation is on the labor side, on the services side, on the shipping side, on the all these bottlenecks and such that were supposedly created during this period of time, then that may take a much longer time for it to come down, as opposed to commodity prices crashing.
Exactly. I agree. Yeah,
I
we
mean, you
went
see
through a
it, I'm sure. I
cycle.
think you
Yeah.
talked about it in your interview 2 weeks ago. I had listened to, I forgot who it was, Michael. Who did you have it with?
I've lost track. I think I was with maybe Ahan from Prometheus, or I don't know. I
Yeah,
don't
you
know.
were you were
Someone.
talking though about you were talking in that about how you were seeing a lot of inflation still in a lot of your
Oh,
products.
Michael. Yes, Michael Gayad, my
Yes,
interview, the one where
yes,
I was interviewed. Yes, thank you.
yes.
Yes, that one.
I had
Uh-huh.
listened to that, and
Thank you.
I had listened to the whole thing, and you were talking about how you were still seeing a lot of inflation
Yes, we
in the,
are.
and that you're still getting, and that inflation sounds like it, from what I listened to, and maybe I was wrong, sounded like it was actually coming from everything happening in between.
Yes, exactly. It was. It is. It's a supply side pressures still present. I was questioning whether it was entrenchment, and are some of my vendors just capitalizing on the anchoring of the high inflation, or are these prices still elevated and increasing? So I don't see any prices coming down. I have seen them increase, and we see that every day as a consumer. And not only am I seeing on the manufacturing and the business side, but I see it as a consumer. And so, absolutely, I agree. So I think we may be at a new higher level. We had a stagflationary nominal growth, some people call it, just a higher inflation cycle from 60s to early 80s. And then we went through that cycle, like you mentioned, more of a disinflationary real growth period. And now we could be going back to that other cycle. So even though Powell seems so confident that we're going to 2%, it seems that maybe we could be at a new level, a new higher level for quite some time. Like you just mentioned, maybe at a 3% or maybe 4%. Do you think that's a possibility, that we might just have to accept that? Because some prices are not coming down. They're just so sticky. And we have new fees, and we have so many elevated pricing across the board. It's not just shelter. People's like, oh, and rents come down, the housing prices come down, we're going to be good again. No, there's prices elevated in the middle, like you said, and at all levels. And there's a bottleneck. It will take some time to work through. So we may have to accept a higher level of inflation. You think that could be the case then?
I actually do, and one of the reasons why I think
Yes.
one of the reasons I do think that, I did that in a video for my subscribers this week on the Seeking Alpha platform, was um, I was looking at, so MZM used to be a figure that was put out by the government, and it's not anymore. And but I went through and I recalculate MZM, right? So it's M2 plus these a couple little small other figures that go into it. And the reason why I liked MZM was because I like to look at the velocity of MZM because it overlays nicely with the 10-year yield. It's almost a great correlation, right? And money velocity is basically just an equation of nominal GDP divided by nominal money stock, right? And what's interesting though is that throughout the 1980s, 1990s, 2000s, 10s, and money supply was growing at a faster pace than that of GDP. And so that was creating this disinflationary force in the economy because, even though you had money supply growing, it wasn't passing through the economy as quickly. It was passing through the economy at a slower rate. So velocity was falling continually until you got to 2020 when velocity actually went below 1 because money supply, MZM, was bigger than nominal GDP. So fast forward to today, what happened at the end of 2021? Money supply stopped expanding, but nominal GDP growth did not. Nominal GDP growth accelerated. So now nominal GDP growth is like 26 trillion. MZM is like 23.5 trillion. So you have the velocity of MZM actually increasing, which is your inflation. And so what's interesting is that if we don't start, in some ways, I'm beginning to hypothesize that what the Fed is trying to do is pull nominal GDP growth back down to MZM. But the problem is that you really need MZM to start growing again to bring that velocity down.
Do you have any ideas on how we could do that?
You either slow nominal growth or you somehow increase money supply.
Wow. Yeah, I mean, it's simple math. It's hypothetical. It's simple math equation.
When you look at the data, I mean, all it is a straight ratio. You have nominal growth on one, nominal GDP on one side and nominal MZM on the other, supply and demand, right? And if GDP is growing at a faster rate than money supply, your velocity is going to increase. And so that's what's happening right now. There is no money supply growth. It stopped. And so if that remains the case and velocity continues to increase, then you're going to continue to have a persistent inflation problem because you have the same number of dollars passing through the system more times than they were passing through before.
So the Fed's tools there's two ways. There's taxation, which no one's in favor of, and then there's raising rates. So by them raising rates, how is that going to affect this equation?
They're hoping to bring nominal GDP down.
Well, hopefully it works.
Well, but the problem is
eventually,
but that's a lot of pain though.
It is. And I said there's a lot of pain. Yeah.
There's a lot of pain going from a 6.5 or 7% nominal GDP growth rate to 0 or negative. Right?
Yes.
Because it's not the same as real GDP, right? Which accounts
no,
for
big difference.
Inflation.
Inflation. Yes.
Here you're actually talking about a nominal decline in GDP, which implies a nominal decline in CPI, the actual CPI index declining. And that's not
significant.
Yeah.
That's significant.
If you have to get back to a balance between money supply and, just thinking about the ratio specifically, if you think about getting back to like a 1-to-1 or something that's more manageable, a 1 you got to get nominal GDP from 26 trillion down to MZM around 20. That's a $3 trillion cut in nominal GDP, or almost, more than 10%.
Doesn't look so promising right now.
No, so they have to try to figure out some sort of balance in between. It's not easy to do.
It's not at all.
And that's one of the reasons why I've become more entrenched in this idea that inflation is going to remain high for some time and rates are going to remain high. And that means you have to have equity market valuations reprice to lower levels.
Exactly. Agree. I think that now what we're looking at, I love the charts that you post, and we discussed the equity risk premium, which is very important for everyone to understand that. That is, the risk-free rate rises due to the equity risk premium. SPX valuations and price need to come down because the yields need to rise. So at this point, based on your analysis, where do you believe a relative valuation of SPX PE should be at, and what type of price point of SPX in the near future based on all this foregoing?
Well, I'm looking at the NASDAQ numbers because that's what I have in front of me.
Okay, let's look at NASDAQ. That's great.
The NASDAQ right now, the NASDAQ has is trading its earnings yield is trading at 3.2% higher than the 10-year real yield. So the equity risk premium is 3.2%. That's the lowest equity risk premium against real yields since the summer of 2009. That means that the market is more overvalued today than at any other point in the last 15 or 16 years. Historically, the equity risk premium, or the difference between the NASDAQ earnings yield and the real rate on the 10-year, was somewhere around 3.7% on the low end of the range. So that means you need to see the real yield, the earnings yield of the NASDAQ rise by at least 50 basis points just to get back to the low end of the range. Otherwise, you're talking about needing to go back to around 4.5%, which would be 120 basis points higher. And that's a significant haircut to the current PE ratio.
Absolutely. So our equity risk premium spread right now is about how much you said? 3.25%? 3.25. Now, question I have for you, since we may be dealing with a new level of inflation, not being able to go back to 2% anytime soon, maybe at a new level of 3 to 4%, do you think there's a possibility we may make new lows in this equity risk premium, and maybe the 3.7 low may now be the 3.2 low? Do you think that's a possibility?
You meaning that because we're in a higher inflation, higher yield rate, that the
Maybe
equity risk premium is now lower?
Yes, maybe. I mean, as a possibility, it seems like anything can be possible at this point.
I've actually been wondering that myself, because
Yeah, that's why I've been wondering.
because it almost looks like if you do the 10-year, if you do the S&P 500 versus another way that I look at this sometimes is by looking at the dividend yield of the
Yes.
S&P 500 versus the 10-year rate. And what's sort of interesting is that right now the spread between the 10-year yield and the S&P 500 dividend rate is 2.3%. And if you go back, like, that rate is obviously the highest it's been now since, again, going back to like 2008, 2009. But what's interesting, though, is that rate in much of the 2000s was, in the 1990s, was as high as, that spread was as high as like 5%.
Yes.
So it could very well be that as we come out of this low rate, low inflation world, these spreads are actually resetting.
Yes, that's what I think.
And
they could be.
They could be resetting to different variables, going back to what they were during a higher interest rate environment. And honestly, I won't know until we get there.
Of course. We'll know in hindsight. We'll know after the fact.
Right.
That's how it always is.
And so what that sort of would indicate is that, maybe equity valuations sort of are stabilizing around 15 or 16 times.
Yes.
And they don't need to go to 11 or 12, right? Or 13. And that's really what we don't know yet. But if you do go back and look in the 1990s, if you do the 10-year yield minus the S&P 500 dividend yield, you get a range between, call it the 1998 sort of lows was around 2.5% when we went through that debt crisis, long-term capital. to a high of 5.07% in like 1997. And it peaked at 5.7% in the year 2000. So it's possible that you could have, a 2.5 or 3%. Well, I would say a 2% dividend yield on the S&P 500, and a 7% 10-year yield.
Yes.
If you do a 5% yield spread. So I mean, but again, it's the type of thing that you're not going to know until you're there.
You won't know, but it's a great idea. I'm happy we both had the same thought, that we're thinking maybe the equity risk premium can reset, and that maybe we're in a new time, and maybe it could go to 3.2. Maybe that could, what we're in now could become the new low. Maybe it could be a norm for a while. I mean, we have high debt, high dollar, we're in a bear market, it's all these all these issues going on that, we are in a different time, and maybe, it can reset. And speaking of the dollar, I see now it pulled back to 110. Are you in the camp of thinking that it peaked, or you think we're in for more?
Oh, I think it's going much higher.
Mm-hmm.
I don't think it's peaked. I mean, look at what's happening everywhere else in the world.
I know. Yeah.
I mean, you have, Japan still doing yield curve control, right? It was funny because last week they did, they come out and they're like, we're going to be doing low rates because we don't have enough inflation. And at the same time, I think the government issued a stimulus to help people with inflation. It was like the most bizarre thing. I thought I was reading a mistake.
Who needs to watch TV when the real world provides enough entertainment and outlandish? Agree. And then everything that's happening with UK. And I mean, we have a whole story here.
Well, tomorrow you have a BOE meeting.
Yes, right? I saw that in your post. Yes.
Yeah, and then you think about what's happening in Europe with their double-digit inflation rate. You think about what's the slowdown in China. So where are you more likely to want to have your money? You're going to want to keep it in dollars. I mean, believe it or not, as bad as it is here with our inflation problem, it's worse in other parts of the world. And you have to think that if rates continue to rise here and spreads sort of continue to widen in favor of U.S. dollars, then you have to think that the dollar can potentially have further upside here.
Exactly. It's basic supply and demand. So It goes back to that. So if this is where everyone wants to be, that valuation and that dollar amount is going to go higher. So that makes sense. I agree. I also think that that is definitely a strong possibility. I want to talk about your recent tweet. I loved it. I thought it was great. I love all your tweets, but the SPY G over the SPY V. Now, for everyone who may not be familiar with that, I watched that as well. It's the ratio between the S&P 500 growth ETF against the S&P 500 value ratio. Yes, and value ETF, I'm sorry. Yeah. And so we're noticing that the growth is declining significantly, correct? While the value is increasing. Could you explain that?
I mean, that's basically the phenomenon that you're seeing taking place between the NASDAQ and the Dow. Mm-hmm. Right? And basically what this is everyone is switching from these high growth names to value names, or probably, again, value names because they represent some sort of lower valuation or present attractive opportunity. I think this is because the market is learning and accepting that we are going to be living in a higher rate world. And not only that, these growth stocks aren't delivering the growth that everyone thought they were going to deliver, aka the results that we had last week out of a lot of these companies over the last 2 weeks. Just weren't as good, right? And so their growth rates are actually being impacted by the slowdown in the economy. And so now people are sort of switching from those high growth, high multiple stocks into the lower valuation, steadier growth, more predictable. I mean, one of the stocks I actually use as an inflation gauge right now is Archer Daniels Midland, the food company. The stock is like at an all-time high. It doesn't probably bode well for where inflation's going because it's highly correlated in my analysis to CPI over the last 5 years. But I mean, this stock is, this is like the new environment we're in.
I mean, have you looked at General Mills even? I mean, that's a nice looking chart. It's a pretty steady
Yeah,
increase. I mean,
I see that
it's
now.
all of these, yeah, all of these. I've spoken about that a few times, and all of these stocks. I mean, I'm a very, and we've discussed this many times. I'm very fundamentally based, having
Right.
been a CFO for a long time. I'm a math person anyway, so I'm actually really pleased to see a return to fundamentals mattering. And
Yeah.
so I look closely at all of these earnings reports. And of course, you've heard me mention SMCI, and that's a beautiful earnings report, low PE. And you should check that one out. I don't know if you have already, but
Which one is the symbol again?
it's SMCI.
Oh, yes, I
And I've
seen
been
you tweet
I
about
think
this.
I tweet and I talk about it in every space
Oh
because
my
I
God.
want to teach people. I just want to help people and guide them
Right.
to what to look for with strong fundamental companies. And
Right.
I mean, I've been doing this since before 2000. So I've always been analyzing companies and investing and trading and so forth. But that's beyond the scope of this discussion. So you look at their earnings and you look at how they raise before the earnings, they come out on the earnings, they beat, and then they raise again. I think their earnings per share is up over 500% year over year this quarter, and quarter from last year. And that's just an example of just solid numbers and what we look for. And I think it's like a selective stock company world we're in right now. There's like selective stocks. Fundamentals matter. So we need to do a deep dive. And that's what I do. And I enjoy it as well. So yeah, you can find, I can't really say, there's some sectors that are performing better than others. I mean, I think some biotechs, and you have the healthcare is doing very well, like CCRN. But overall, it's a selective stock market. So we just need to be very picky with the companies that we choose. And that's just an example of a good one. I like you mentioned Archer Daniels and GIS, and these are all value. To me, SMCI is a value play. I know it's a high growth, but their PE is so low. Their numbers are beautiful, as if you expect from a value play. I mean, it's very undervalued. When I entered, a while back, it was very undervalued. It shot up a lot today based on the earnings yesterday. But to me, it's still, it's like a value. But I'm long term. I'm not trading it. So I'm just holding it for the long term. And you know what else is an interesting ratio? I'm sure you've looked at the SPLV versus the SPHB, which is the low volume
low
versus the
volatility.
high beta. Yes, the low
I haven't
volatility. I'm
looked
sorry,
at
the
that.
lower volume. Okay, the low volatility versus the high beta. And the low volatility is increasing significantly as well. So that's very
I
telling.
haven't looked at this before.
Oh, okay. Well, you should check it out.
Yeah.
So that's great. So, if the ERP, like we said, and I'm so happy, I'm so pleased that we both thought the same thing. If that can reset, then maybe we're not due for that much more of a downturn. And maybe we can hang around this level, or maybe just a little lower, and not necessarily this big, decline.
Well, that's all going to also depend on what the E is.
Exactly. And we don't know.
And that number is coming down.
Well, the earnings are significantly under pressure. We have compressed margins. We have slowed growth. And once the rates go work through the system, we have lower valuations. And then, there's a dilution of value. I mean, we have increase in cost of capital, production, labor, and productivity's down. That's another thing. Oh, on that interview, I discussed that. Productivity is significantly down. There's less output per every capital dollar that's invested. So I actually use that term, dilution of value. We're getting less output for every input. And to me, that's just clear inflation across the board. Revenues are elevated, mostly due to inflation rather than higher output and volume. So, exactly. And that all corresponds to the E. And now you and I had a great discussion about Q3. We may not see the effects, and we may actually see that later on, Q4 or into next year.
Right. And really, you are starting to see finally earnings really start coming down for going forward, right? And we weren't really seeing that going into this third quarter. But, since the third quarter began, let's say, reporting season started on September 30th, they were estimating S&P 500 2023 earnings of $243.80. And now they're down to $237.40. So you already see they're starting to come down.
Yes, they're starting to come down. Absolutely.
And they're likely to probably continue to come down.
Well, we can see it even in the earnings reports that it's been consistent since last quarter that margins are coming down. So we have significantly margins are coming down, and except for like a handful of stocks, which like I mentioned before, selective stocks. Enphase, I think, kept their margins or raised them a little bit. SMCI raised their margins up to 18% now, I think from like 16 or something. So you see a select group of companies, and to me, they're the most efficient and effective companies with their business models. And either they're differentiating themselves, they're also integrating vertically and horizontally, and they're doing all different ways of increasing their productivity and maintaining their margins, which is very important during these constrictive times. So ultimately, it's about finding being a cherry picker and just finding those companies out there, because there are out there, and they're emerging leaders, in my opinion. We see older leaders fall and new ones emerging. So very interesting stuff. I love talking to you, and what a great discussion we have. Is there anything else? Yeah, it's always good. I love talking to you. Is there anything else you wanted to mention, Michael?
I don't think so. I think you just have to, like we've talked about in the past, you just have to watch the bond and dollar and bonds and dollars, and that's it. They're going to, and the TIP ETF, they're going to continue to be the leader in this, and they're going to continue to tell you which way markets should be going. And as long as yields keep rising, the dollar keeps strengthening, that TIP to ETF keeps falling, it's going to tell you that stocks are going to stay under pressure. And that's really, I think, the moral of the story.
And it's important to look at the tips, because the inflation data is all backwards looking. So we need to use the tips.
Yeah.
Exactly. So awesome.
Otherwise, I don't have anything else to add.
Okay, great. Well, it's awesome. Risk management is key. Reduced position sizing has been my strategy overall, and it's worked very well. So
I've just been extremely patient. My strategy
exactly, you
is
are.
let the market come to me.
Exactly. I admire your patience, and I've been patient as well. I've been keeping busy and just watching, observing, doing less transactions.
Right.
As the famous Charlie Munger once said, the best thing a human being can do is help another human being know more. So I think we accomplished that. Well, I'm hopeful that we accomplished that today with this great discussion with you, Michael. Thank you so much. And happy birthday to you. Your birthday's on Friday.
Oh, you saw that on my thing.
Yeah. Of course I saw that. I'm going to send you a big happy birthday tweet on Friday. And we're supposed to be meeting up soon in person. We live near each other, by the way, everyone. So we're going to be meeting up for some coffee or something. We're going to be talking.
We can have more in-depth Fed discussions.
Absolutely. I'm going to love talking about that equity risk premium theory that we have. So thank you, everyone, for listening. And until next time, have a great evening. Take care.
Bye.
Bye.
Thank you for listening to the Rose Show podcast. Please visit RosannaPrestia.com for more episodes. See you soon.